Hello, everyone, and welcome to today's webinar entitled Navigating the Retirement Roadmap, brought to you by Tandia Wealth and in partnership with Fidelity Investments. My name is Russ McKay, and I'm the AVP of Wealth Management Services here at Tandia. We're thrilled to have you with us today as we're going to explore a topic that's incredibly important for all Canadians, which is preparing for a financially secure and fulfilling retirement. Today's presentation, we're going to walk through not just how to save for retirement, but how to strategically plan for it, from understanding CPP, old age security, managing some key risks like longevity, asset allocation, withdrawal rates, inflation, healthcare. These are all many of the real world concerns that we speak to our members every day about. If you have any questions during the presentation, please use the chat feature. We'll have a Q&A portion towards the end, and we'll do our best to answer as many questions as possible. If we run out of time, as always, don't worry. We'll follow up after the webinar with some answers, and we'll also share contact info if you'd like to reach out and speak with someone one-on-one. Here at Tandia, we really pride ourselves on those discussions with our members and on delivering a financial planning experience that's as unique as you are. We're very proud to be member-owned, and our wealth advisors here at Tandia are helping thousands of our members now every year create smart, customized plans to help them prepare for retirement, living through retirement, estate planning. And with that, we're incredibly fortunate to once again be joined by Michelle Munro, Director of Tax and Retirement Research at Fidelity Investments. Fidelity is a longtime trusted partner of Tandia. Michelle and Fidelity Investments have worked closely with our wealth team for years now, and Michelle brings a very powerful blend of insight and clarity to retirement topics that I'll say really matter. Michelle is a CPA and a CA with an extensive background in corporate tax, retirement strategy, estate planning. She's been with Fidelity since 2008. She's also been a leader in advocating for women's financial empowerment. So, Michelle, we're really happy to have you back with us today. So thank you for being here. And with that, I'm just going to hand it over to you to dive in.
Thank you, Russ. It's a pleasure to be here today. And as you said, we're talking about the retirement roadmap, which is the retirement journey. And we have a number of people on today. Well, before I get into that, I want to say we're one of the many resources that work with you behind the scenes to giving your clients the very best. So, Russ, and thank you for organizing today. And lead me into, we're going to be talking about the retirement roadmap. And we have a number of people on thinking about retirement. What does that look like? To use a golf analogy, it truly is a long game for even when somebody's preparing for that, and even when somebody's in retirement. And we'll get into some of the nuances, but we'll talk about, well, what does retirement mean to individuals? Looking at the financial aspects. What are some of the risks in retirement? And I want to wrap it up with a little bit on estate planning. So we have a pretty packed agenda. With that, I have my very important compliance slide, which is just, these are general topics. And what I really hope for the audience today is to take something away, no matter where you are in that life's journey, retirement roadmap, and ask some questions about your particular situation, maybe with a partner, other family members. Taking it back, talking with Russ and the team about, well, what could you be doing today, making small changes, but incremental changes that could have potentially a big impact on your retirement. So with that, let's get into it. Here's a happy fella. I think that's a trombone or something. Thinking about retirement. And when most people think about retirement, they are happy. There's something they're looking forward to. So let's start with, what does a retirement vision look like? Well, for various people, it will be meaning different things, but they sort of generally go into different buckets, 3 different buckets. Thinking about play. This is travel. Maybe it's entertainments, activities, spending time with family and friends. Learning is the second bucket, something we didn't have time for during our working years, a hobby, a passion. And on the third bucket, what we're seeing more and more are people who are choosing to work in retirement. It's no longer a hard stop of the working years. It's more of a phased in approach, a transitioned approach into retirement. And with that transition is working part-time. Something that's retiring from that primary career, working as a passion type job before that sort of traditional full-time retirement. At Fidelity, our goal is to ensure that you're financially secure to be able to do any and all of these things that you want to do. And also thinking about, well, the first third of retirement will probably look considerably different than the last third of retirement. So being able to do any and all of these things for the entirety of your retirement, which leads me into, well, how long can we expect retirement to last? So this chart is looking at the average age of retirement in Canada. Starting on in the left-hand side in the mid-70s, the average age of retirement was age 65. And it steadily declined to the late 90s when we sort of bottomed out there at about age 61. And it hovered there till 2008, 2009. And then we've had a steady increase since then. So we're back to 65 and a half as the average age of retirement. So if you think about how long is retirement going to last, well, on average, it starts at age 65. And how long will it last? Well, we're looking at life expectancy. So here we have average life expectancy. On the top section, we have those who are in the 1980s, men at age 65, they're in the dark blue, on average could expect to live just shy of 80, women just shy of age 84. Today, those averages have generally increased, where men at age 65 on average could expect to live to age 80, just over age 84, women just over age 87. So a couple key takeaways from this. Well, in general, life expectancy is increasing. So by that, I mean, when I turn 65, I can expect that those averages will be higher than they are now, as well as particularly important for the women in the group and those who have a woman who's important to their lives. Women, we can expect to outlive the males, the men. So what does that mean for retirement planning? Well, if I live 3-4 years longer than a man does, how much more do I need to save during my working years to be able to fund those additional retirement years? Meaning that retirement planning can be more complicated for women. Okay, so let's continue on and look at some of the financial aspects of retirement planning. So I want to start, and this is looking at the life cycle of an investor. Over on the left-hand side in the green, somebody who's just getting started first in their career, maybe they're getting ready to marry, buy a house. There's a lot of competing financial priorities. Now, I can't see our audience today, but for anybody who is in this age category or maybe has a child or grandchild in that sort of just starting off their life cycle as an investor, the importance of getting started, learning the discipline of saving, investing a little bit of every paycheck. And these are good financial habits, which will really serve them well for the entirety of their adult lives. Now, as we go up that green section, you can see, well, people have a little bit more to be saving and investing, but it's really not until they get to the orange section, that transition zone, where people are like, whoa, 5 years from now, I'm planning on retiring. I gotta figure this stuff out. And it honestly takes 5 years after retirement before we head into this blue zone on the right-hand side, where somebody is living in the retirement, that post-retirement life cycle. So on my next slide, I'm going to focus on what people are thinking about in that transition zone. But this conversation really applies no matter where you are in the life cycle. So the 5 years before retirement, thinking about, well, what does retirement look like? We do an annual retirement survey at Fidelity, and we ask, what would you like to do in retirement? Consistently, the number one answer is, I want to travel. I'll say that men put travel higher on their list and women put it a little bit lower on the list. So the importance of talking with a partner, well, okay, we want to travel, but also what does travel mean to individuals? It could mean multiple luxury 5-star vacations, or it could be something more economical, maybe driving across Canada in a Winnebago or something like that. But what are those retirement goals? What does that vision look like? And also bringing it back to the earlier conversation is that, well, retirement could last 20 years, 30 years, or longer. And certainly that first third of retirement will look considerably different than the last third of retirement. So really thinking when you're creating that vision, what does that look like? And with that, thinking about those expenses. What is that vision? Is it more of a luxury or is it more economical? But also thinking about what are your day-to-day expenses. And with that, what are the sources of income? We call this the retirement paycheck, and I'm going to do a deeper dive on that. But before we do, I want to finish off on this slide. So what are the sources of income? Typically, the 5 years before retirement, people are also really doubling down, making sure that they're reducing or eliminating their debt before going into retirement. And these are often the years where people are really double down on investing, topping up those retirement savings. Now, as I said, it typically takes about 5 years after retirement to get into that post-retirement budget, which means that one would have to have a post-retirement budget. So thinking about that, what does that budget look like? And monitoring what are your withdrawals from those retirement savings, reviewing this at least on an annual basis. The final bullet I have here is finding a social structure. The reason I included that in a financial aspects of retirement, because I think like, well, it's a little bit more social, but bear with me for a sec. During one's working years, during our working years, well, we spend about 8 hours a day, maybe more, maybe a little less, 5 days a week working. And that also provides a social structure. Once we move into retirement, well, that social structure that came from our working environment is eliminated or at least significantly reduced. So what does that social structure look like in reestablishing that? And what happens is it often costs more than people anticipate. And that comes into the budgeting aspect. So budget a little bit more. Dinners out, entertainment, hockey games, baseball games, you choose, whatever you think that looks like. Thinking about that and incorporating that into your retirement budget. Okay, so I talked a little bit about the retirement paycheck. I work at Fidelity. I get a paycheck. It comes every other week. It pretty much looks the same. When I move into retirement, there's all these different sources and sometimes are taxed differently. So I want to go into go into 3 different buckets. The government sources, and the 2 most common ones are Canada Pension Plan and Old Age Security. And we'll look at these in a little bit more detail. But before we do, so those are the government sources. Next, you might have an employer source, which was a defined benefit pension plan, a defined contribution plan, or perhaps a workplace sponsored registered retirement savings plan. And then you have all your individual investments as well, or income sources. And those are a personal registered retirement savings plan, perhaps a tax-free savings account, non-registered investments, which will produce interest income, dividend income, or potentially capital gains, maybe rental income, maybe dividends from a private corporation, maybe life insurance and annuity. Sometimes we're getting closer to the bottom, accessing home equity. This is where somebody sells their big home and then they downsize into a smaller home. They use that net equity to help fund their retirement. Employment income, I talked about that one already, where we're seeing more people taking a phased-in approach to their final retirement years of what that looks like. And inheritance. And the reason I put some question marks here, and I'll say this as a bit of a joke, but there's honesty to this. For my children, when it comes to their retirements, if they're hoping on an inheritance from me, well, that is a risky strategy. One, I'm going to live a long, long time. So the timing of that is certainly uncertain. And with that is that I'm planning on spending everything my own little nest egg, meaning a small inheritance for them. So I say it as a joke, but it is a risky strategy. Okay, so I started off with, we were looking at Canada Pension Plan, Old Age Security. Those are the two most common government sources of this retirement paycheck. So let's do a little bit of a deeper dive here, starting with Canada Pension Plan. So during our working years, we contribute to Canada Pension Plan. It's withheld from our paycheck. Typically, we don't give it too much thought. Now, once we enter into retirement, then we can start to collect Canada Pension. So age 65 is considered the standard retirement age. And depending how much one has contributed, and if you're entitled to 100%, it's just a little over $17,000. Okay. Now, however, we could take CPP earlier than age 65. The earliest that we could take that is at age 60. Now, if we take it before age 65, we get a reduction of 7.2% per year. So if we start at age 60, well, we get 64% of what would be entitled to otherwise, a little over $11,000. Now, on the flip side, we can delay taking CPP after age 65, and we get an increase of 8.4% each year. Now, the latest we can delay CPP is age 70, and then we get 142%, just over $24,000, shy of $25,000 per year. So you can see that the government definitely is incentivizing people to delay taking CPP, because the increase for delay 8.4% versus the decrease for taking it early 7.2% per year. Well, they're not tit for tat, they're unequal. I should also mention, these are the maximum payouts here. The average CPP pension at age 65 was just shy of $10,000, which means that people didn't make the maximum contribution for the maximum number of years on average. So if you're concerned about, well, how much CPP would you potentially receive, you can look it up on Service Canada. As an alternative, you could give them a call and they can give you that information or show you where to find it on, it's also available on CRA My Account. Okay, so that's CPP. One of the questions I often get, well, when is the best time to take CPP? Well, what I did here is I'm going to annotate. We did some math. and we said, okay, here's somebody who takes that reduced amount starting at age 60, and compare that to someone who takes the standard full amount at age 65. And cumulatively, so start earlier, but take a lower amount, cumulatively, what is that break-even number? Well, it's age 74. So what that means, if I live beyond age 74 and I took the standard amount starting at the standard age, well, I would have more in my pocket cumulatively. So we call that the break-even age. So we did the break-even age between starting at age 60 and age 70, and that's break-even age is age 79. And again, at age 65 and age 70, starting at that page. And that break-even age is age 82. And if you remember, when we were looking at average life expectancy, men were just a little bit over age 84 and women were a little bit over age 87. Statistically, well, both women and men outlive that break-even age, so it would be better to delay taking CPP. But there's some other things to be thinking about as well. Well, what age do you actually retire at? What other sources of income do you have? So there isn't a one-size-fits-all approach. And this is an area where Russ can help you figure out what is the best decision for you. The next slide looks at, well, when did people actually, oh, I went the wrong direction. Here we go. When did they actually start taking CPP? And we're comparing between 2017 and 2023. That was the most recent when we updated this. And what we can see is that over on the left-hand side, fewer people are taking it at age 60. And then as we sort of, it's a little bit gradual, but then there's more people who are delayed taking their CPP. I like to think that people watched my presentation and were making an impact on people thinking about it. But in reality, it might be just a reflection of that people are now delaying taking their CPP. But in any case, because we have longer life expectancies and people are living longer, people are also delaying CPP. All right, so this is CPP. You pay into it, you get out of it. There's also old age security. It's slightly different. Old age security is based on residency in Canada. And so at age 65, that's the earliest we could take old age security. Being a resident in Canada for about 40 years, be entitled to $8,700 per year. Now, if you were only a resident in Canada for 30 years out of the 40, you get 3/4 of that amount. Now, there's no option to take old age security earlier than age 65, but you can delay taking old age security up to age 70 is the latest. Every year you delay it, you get an increase of 7.2% to a maximum of 36%. Should also mention that for seniors who are 75 and older, they get a 10% increase. Now, with CPP, you paid into it, you get a benefit from that. Old age security, it's based on residency. So the current tax pool is paying for the recipients of old age security. So it's a little bit different that way. And there's also a clawback for higher income earners. And what that is when taxable income is at $90,997, every cent of that, every dollar of that over that threshold, 15 cents of old age security gets clawed back. So then once an individual reaches $148,000, all of their old age security is clawed back. So many seniors try to manage their taxable income to be at that $90,000 or less to ensure that their old age security is not clawed back. Yeah, I think that's all I want to cover on old age security. Next, I want to talk a little bit about registered retirement savings plans and tax-free savings accounts. And compare and contrast them a little bit and also talk about some strategies that could go along with them. Let's start with registered retirement savings plan. They've been around for over 50 years. It's based on earned income, which is essentially employment income. We have RSP contribution room based on our earned income, up to a maximum of about $32,000 in 2025 this year. You make a contribution to our RSP. We can get a deduction for a tax deduction for that RSP contribution. Reducing our taxable income, typically that means we get a tax refund, lower our tax liability. Then, while we have our investments inside the RSP, we can invest in mutual funds, exchange traded funds, stocks, bonds, the list goes on, and really thinking of them as investments. And these investments grow on a tax deferred basis until retirement. And then it gets a little bit complicated here as we're approaching retirement, and in the year we turn 71, December of that year, that RSP needs to be matured. Most people mature it into a registered retirement income fund, a RIF. And then we start to draw down that RIF to provide us an income source in our retirements. Now, if we withdraw $1,000 from our RIF, $1,000 of that is taxable. Now, when it comes to a strategy, which I'm trying to illustrate here, our strategy here is we want to get that when we're making that contribution and getting a deduction for that RSP contribution, we want to do that at a high or higher tax rate. And then when we're making that withdrawal, typically in retirement, we're in a lower tax rate. So that's why here we're saying late career, typically in a high or higher tax bracket, really focus on that RSP for retirement savings. So next I want to shift and talk a little bit about tax-free savings accounts. They were first introduced in 2009, so they haven't been around nearly as long. And let's see. So let's start off with making a contribution to that TFSA. Well, let's start with the contribution limit. First of all, you have to be over 18 to be able to contribute to a TFSA. And that's when you start earning contribution room. Now, the contribution limit has varied over the years. It started at $5,000. In 2025, we're at $7,000. And based on your age, that's how much you can contribute. If you were 18 in 2009 when they were first introduced, your cumulative, and you haven't contributed anything to a TFSA yet, your cumulative TFSA contribution room would be $102,000. So they've grown, they're pretty substantial. Okay, so we've made our TFSA contribution. We do not get a tax deduction with that. So we say it's made with after tax. That contribution is made with after tax earnings because there's no tax deduction for that. But now we have our investments inside that TFSA. We have what we can invest in the same things as the RSPs, mutual funds, exchange traded funds, stocks, bonds, what have you. Think about it as investments. Those earnings from those investments inside the TFSA, they are tax-free. So we're not paying taxes on them. A TFSA is more flexible than an RSP as well. There's no requirement that it needs to be converted to anything, and when we go into retirement, it can continue to be able to contribute to a TFSA even into retirement if one's able to. What else can I say? Oh, there's also more flexibility with the TFSA. If for some reason, let's say I was going to go on a big trip this year and I wanted to make a withdrawal from my TFSA, I could make that withdrawal. And let's say withdraw $10,000, I could recontribute that in a later year. So if I make a withdrawal, I could recontribute that in that TFSA. There are not similar rules for an RRSP. So we like the TFSA, so it's a little bit more flexible. So this is why I've put it in the early career section. Typically, somebody's in the early career, they're in a low tax bracket, so they're less concerned about getting that deduction from the RRSP, so they're able to let that, they're not concerned about that. They also want that flexibility. Maybe they're going to use that for traveling, maybe for putting a down payment on a home. We don't know. We just want to have some more flexibility there. I should also say that the withdrawals from that TFSA are tax-free. Just to wrap up this page, over on the right-hand side, I touched upon it a little bit, but investing in a TFSA in retirement. Once you've turned 71, you cannot contribute to your own RRSP anymore. But if you have available funds, taking advantage of that tax-free savings account. And it could also lead into your own estate planning as well. But we'll get into that in a second. So the key takeaway, well, actually, before I go, let's summarize a little bit. An RSP, we get a deduction for those RSP contributions. Investments inside the RSP grow on a tax-deferred basis. In retirement, when we're making the withdrawal from our converted RSP to a RIF, those withdrawals are now taxable. The strategy is we got a deduction at a high tax rate, income inclusion at a low tax rate. TFSAs, they've been around for a much shorter time. No deduction for making that our TFSA contribution, but the investments inside the TFSA are on a tax-free basis. Withdrawal from the TFSA is tax-free, also more flexible, so we can recontribute that in a later year. Now, when it comes to retirement planning, think about your sort of average individual, starts working at sort of 25-ish, works until 65-ish, we've got 40 years. But how long is retirement going to last? Well, on average, 20 years, but it could be 30 years or even longer. So again, coming back to retirement is a long game. To the extent that one is able, maximizing both the RSP and that TFSA to really focus on maximizing that nest egg for retirement. Okay. Now I'm going to switch gears again. Here I want to talk about the 5 key risks in retirement. I'll go into these in some more detail, but just to top it off a little bit, what are the key risks that could impact your retirement planning? Longevity, inflation, asset allocation, withdrawal rate, and finally, healthcare. So let's start off with longevity. So earlier in this presentation, we talked about averages of how long women and men could expect to live. But those are averages. Looking at the 25% probability, well, men, 90%, women, 93%, at least one person in a couple living to age, 25% probability of living to age 95. I was at Shoppers Drug Mart the other day looking at birthday cards, and there's a whole section there for happy birthday, 100 years old. Bananas. So part of that is just thinking about, well, we could be living in retirement for decades, 20, 30 years or longer. Well, when it comes to retirement planning, the risk here is that you lived longer than you expected and outlived your retirement nest egg. And this, again, is an area where Russ can help you mitigate that risk. Next, looking at inflation. So let's start. What is inflation? Well, it's been in the news for the last couple years pretty consistently. What it is that it's your ability to it's your ability for purchasing power. It generally decreases. The Bank of Canada has a target inflation rate of about 2%, which we've gotten much closer to in recent months and quarters. So just talking about your purchasing power, this is somebody who has today a $70,000 purchasing power. With a 2% inflation rate over 25 years, that individual is only able to purchase $42,000. The key takeaway is even with a low 2% inflation rate over a long period of time, it does reduce your purchasing power. I think in recent years, we got pretty close to 8%, and it was just for a short period. So I don't want anyone to be, because it was just a short period. But if we had that over a long period, that would reduce the purchasing power from $70,000 to $10,000. Pretty significant. So things to be thinking about. CPP, old age security are both indexed for inflation. So when you're going back to that retirement paycheck, we have two government sources that are guaranteed, indexed for inflation, which will give you that comfort. Some people have defined benefit pension plans. Some defined benefit pension plans are indexed for inflation, some are not. So you want to be aware of what does your, if you have one defined benefit pension plan, is it indexed for inflation? Thinking about investments, there are some investments that are more resilient to inflation. Just looking over on the right-hand side here, inflation-linked bonds, gold, commodities, real estate, floating rate notes, what have you. They could help mitigate that. Again, mitigate inflation risk. Again, this is an area where Russ can help you. Next, I want to talk a little bit about asset allocation. The way I'm going to sort of launch into this is thinking of, well, a generation ago or more, it would be sort of more common that one retired, got their gold watch, it was a hard stop, moved any and all of their investments into Canada savings bonds. And at that time, it probably wasn't a bad strategy because interest rates were high, double digit, life expectancy was shorter. Whereas today, that strategy is not going to be a winning strategy. And this is just saying, well, thinking about, well, retirement, what is our duration or time horizon for that? And I've said this a couple of times different ways, but we could expect retirement to last decades, possibly 30 years, which is a long time. So that strategy of that super safe Canada savings bonds, which you can't even buy anymore, it's not a winning strategy. So having asset allocation, looking for growth, having the various sources, and we've listed them out here. And this is an area where Russ can really help you tailor a portfolio for your specific needs. Thinking about withdrawals, and looking at the withdrawal rate. And what this is looking at is someone who has $500,000, and this is their 4%, which is the blue line. They take out 4% each year, and they're in an they're in a balanced portfolio. If you look down here in the small details, we have our balanced portfolio details. So, and 4% over a number of years, and we're looking at almost 30 years, they're actually able to grow their portfolio. If we move that down to, 4.5%, running out of money at about age 92. If they use a 10% withdrawal rate, they run out of money at age 75. It just lasts about 10 years. So all this to say is thinking about, well, we have our retirement nest egg. How much do we withdraw each year with the goal and objective is that we want to enjoy our retirements. We want to, for the entirety of our retirements. Most people, just going back to this, don't want to leave that big of an inheritance. It's somewhere in between. And of course, this becomes tricky because, well, nobody knows exactly how long we're going to live. Don't want to have too much. You don't want to have too little because then you've also sacrificed your retirement years. And also, I'd like to say that for most people, it's not a linear percentage because life happens. It goes up, it goes down a little bit. And again, this is an area where rest can really help you keep your retirement nest egg on track. The final retirement risk is thinking about the long term and healthcare risk. So there's kind of two aspects to this. The first aspect is a little bit easier to understand or talk about as well, is that during my working years, I work at Fidelity. We have pretty good employer provided healthcare benefits. I get my teeth cleaned, I get a massage, a variety of things. They're covered under my employer health benefits. So those out-of-pocket costs are pretty minimal. When I retire, no longer under the employer healthcare benefits, I'm paying for these out-of-pockets. So we did a bit of a back of an envelope calculation to try to figure out, well, how much would, if I was going to pay for the sort of a similar third party, Blue Cross, what have you, healthcare benefits, on average life expectancy, how much would I need to sort of set aside for that cost? Back of an envelope, as a single, you're looking at about $80,000. A couple is slightly less than two singles, so it's slightly under $160,000, which is, when you look at it that way, that's a pretty significant amount to have set aside just for healthcare. So the other aspect of this is thinking about end of life. Fidelity, we do lots of different surveys. We did a survey and we asked retirees, what is your ideal end of life situation? Where would you like to be? And we have some of the options here. 97% of people said, I would like to age in place. It means I'd like to stay in my own home. Well, what does that mean? So thinking about that, so you have options, you want to think about it as far in advance as possible. So what does that look like? Well, if I'm in a home and I need to have yard care, snow shoveling, maybe I have to do some adjustments to my home, those shower bars, maybe it becomes more expensive. Maybe I need to have in-house care. Maybe I need to have a personal support worker, 24 hours a day, 7 days a week. You're looking at over $200,000 per year. And, you know, Russ mentioned that I feel passionate about women and investing. This is one of my passions because women, we statistically outlive men. So this happens to us more often than men, that we are the last ones standing. And sometimes what happens, and I hear these stories again and again, well, Granny's gotten older, she's had a stroke, maybe she has dementia or something, but we know Granny wants to stay in her own home. And the doctors have said, well, you know, Granny, she's got 6 months to live maybe. And we're sort of looking at the different options of like, well, we need to have that additional care, $200,000 a year, which is a lot, but we've looked at Granny's finances. We're looking at, well, doctors say 6 months. So yeah, we can afford that. We make that decision. Well, then what happens is Granny lives longer, 2 years, 3 years, 6 years or longer. We've depleted all of Granny's savings. And then we're looking to the next generations. And so what happens, the typical sandwich generation, if you will, well, we continue to help fund Granny to save that, perhaps to the detriment of our own retirements. So having these difficult conversations, at what point do you make that decision? How do you make that decision? Going over on the right-hand side there, 97% of people want to age in place. That can be very costly. So thinking ahead, what does that mean? Having these conversations, especially intergenerationally, and making plans so there are some options. Okay, that was a bit of a downer of a conversation, but let's continue on into another downer of a conversation, but an important one: estate planning. You know, estate planning, well, we're thinking about death, end of life, that's uncomfortable. We're talking about investments, which can be uncomfortable talking about that, as well as taxes. Uh, it's a trifecta kind of uncomfortable conversations, but it's so much easier to have these conversations today, earlier rather than later. So, from a tax perspective, what happens on death? Well, one is deemed to have disposed or liquidated of all of their assets. And these are reported on the terminal return, in addition to any income that's earned up to the time of death. I should also point out that if there's a spouse, assets can be rolled over on a tax deferred basis to the spouse. But that's sort of like kicking the tax can down the road. Eventually, two truths in life, death and taxes, or two certainties in life, there will be that tax bill on the death of the surviving spouse. So just looking, these are national average tax rates. The more income that's reported on that terminal return, the higher the tax rate. And here what happens: over $250,000 on that terminal return, half of it, over half of that, is going to taxes. So from a tax perspective, I think we would like to minimize our tax bill on that terminal return. So what that means is that if we pay less taxes on that terminal return, beneficiaries would receive more of our assets. So I want to go through it a bit of an example, because this happens again and again. Here we have an individual, there's no surviving spouse. They have a large RIF, and I get to make my examples with big numbers to really drive home the example. A large RIF, $1 million. Half of that goes to taxes, so the after-tax estate is $500,000. Okay, total. And there's no other assets. That's all we have. Okay, is there a way that we could do this more tax efficiently? So if the individual, because what's happening here is that on that terminal tax return, that full $1 million from the RIF is reported on that terminal tax return. Half of that's going to taxes. So if the individual today, during their final retirement years, is in a lower tax bracket, let's say 25%, and we pull out a little bit every year to get taxed at that lower tax bracket, 25%, and I'm going to use $600,000 over a number of years and invest that after-tax amount, what's in a combination of our TFSA or non-registered account. What we're able to do here is, because we've reduced the balance in that RIF, we've reduced the amount subject to the high tax rate, and what we've been able to do is increase the net after-tax estate, meaning that the beneficiaries receive more. And in this case, $150,000 more. And that is savings that has a big impact to the beneficiaries. So there's small tricks that you're doing year after year, a little bit, but it has a big impact at the end of the day. And these examples really do happen. One of my good friends, her father passed away. It was almost 10 years ago now. He had a $500,000 RIF, passed away. Half of it went to taxes. And you know, she still talks about the unfairness of that. The CRA took half of her dad's RIF on death. So Small changes, doing them consistently over a number of years, can have a big impact. So thinking about estate planning, I talked to it, it can be a difficult conversation. You want to come up with what does that estate plan look like? A will in itself is not an entire estate plan, but it's an important component. Is there a will? It's a written document, it's a legal document. Is it valid? Is it up to date? Does it convey one's intentions? The importance of, especially if you have significant assets, of having a will and estate lawyer write that up. Typically, it's done with a power of attorney. A will takes over the assets, the investments, properties, what have you, after one has passed away. A power of attorney designates an agent to make financial decisions on your behalf or medical decisions on your behalf when you're incapacitated for some reason. Typically, lawyers will draft these up at the same time. I should also mention that the will designate, commonly referred to as an executor. It's actually an estate and trustee, but we call it an executor in common terminology. The executor does not have to be the same agent under the power of attorney for medical or financial reasons. So thinking about that. Now, if someone's looking for these important legal documents, do they know where to find them? Sort of traditionally, they would be in a safety deposit box. But if they're there, can somebody else access them? Can that executor get into that safety deposit box? Some families are very transparent and feel comfortable sharing this information. Here's a copy. Or one of my friends, what happened is that her mom was not comfortable sharing the actual documents, but she said, well, if you need them, here's a copy, here's a picture of the desk on the bottom left drawer in the back. On the left-hand side, she pulled out the green folder that the documents are in. This is where you can find them if you need them. A little bit on the bottom left-hand side, thinking about physical assets. We have a picture of a very nice cottage there. What is the plan for those physical assets like a cottage, which have the emotional aspect that far exceeds the RIF or RSP or other investments? What is that plan? And this really leads me into having those conversations, those intergenerational conversations. So you're thinking, well, first of all, between partners, what is the plan? And then thinking about, well, for the next generation and beyond, maybe family, maybe charity, what are your estate wishes? And having those conversations. Because when you think about it, it's a little bit about legacy planning, if you will. When you look at media, there's a focus on the assets, the property, those cottages. But it's also, are your wishes known? Are they understood by the family members? Will there be surprises? There shouldn't be, ideally. Will it be fair? Will it be perceived fair to the beneficiaries? And relying on Russ to help you navigate these conversations, normalize them, so that also forms your legacy. So I like to wrap things up with a quote, and I've sort of said it in different ways throughout the presentation. But success, it can come from very small, diligent, unremarkable preparation and combination over time, many years, decades. Having that foresight can really pave the way for extraordinary outcomes. And, I think people who join my presentations, well, first of all, kudos to you. Congratulations, because you've sat through, you're thinking about these things, taking those steps, really setting yourself up, your partners, your families, and beyond for that success. So Russ, I'm not sure if we've had any questions come through. I didn't see anything pop up. I know I thought I was going to try to keep it to 45 minutes and I've gone over. I apologize. One of the questions I commonly get, can we get a copy of the slides? And yes, absolutely, we can share that, as well as a copy of our retirement report.
Perfect. Thanks, Michelle. That was filled with a lot of great points and valuable insights. I love the golf analogy at the beginning, although that could be somewhat scary if your golf game is as unpredictable as mine. But I think it's still the perfect metaphor for this. That it is a long game. I do want to give an opportunity for Q&A if there's any questions there. I had a few questions submitted to me prior to the presentation as well. But again, if you haven't done so already, please submit your questions using the chat. We're going to try to answer as many questions as time allows. We got a couple minutes here. And once again, if your question doesn't get answered live today, we'll follow up by email. You're also going to receive an email with my direct information if you'd prefer to reach out for a private conversation. But one of the questions I did have for you, Michelle, with the changes in leadership in Canada, does this have any impact on how our investment choices should be?
So Trudeau announced his intention to resign in January. In March, we had Mark Carney was the prime minister, and now we've had an election, and he's in the Liberal platform through the election. Let's talk a bit. There wasn't a whole lot from a tax perspective. There was a commitment to keep the capital gains inclusion rate at that 1/2 inclusion rate. A year ago in the budget, there was an announcement to increase it to 2/3 for corporations and trusts and individuals over 250,000. It's since been reversed and will not be introduced. So we have that comfort. The other piece of that as well, thinking about taxes, we talked about, well, there's different tax rates on different bands. They're going to lower the tax rate on the lowest band by 1%. It'll probably make about $400 difference to individuals once it's fully implemented. For retirees, there will be a one-time RIF reduction of 25%. We're expecting to have that. We should have a federal budget before Canada Day, so the end of June. We should have that, so we'll have this a little bit more clarified. But your question really came to a little bit about more of global politics and the markets. So I'm really focused on retirement and taxes and whatnot. But I do listen to our portfolio managers, and by and large, the importance of having that long-term view, because, markets will fluctuate, having that long-term view. And the second piece of that is diversification, looking at that asset allocation and looking more for global asset allocation. And I know, Russ, you've been working with your clients for years to withstand these blips, if you will. And the market, well, I'm not sure what the markets are doing today. I think yesterday was one of the best days we've had in a few months. So, but having that long-term view.
Great. Thanks, Michelle. I got two other questions here. Can I take money out of my RIF and gift it to a child so that they don't have to pay tax?
Okay, so I'm not sure who asked the question, but I want you to follow up with Russ about your specific judge, because I have to make a few assumptions here. So if you make so we have, let's say, grandma who makes a withdrawal from her RIF. It's taxable. And now she's going to gift, it's taxable to grandma in my situation. She's going to gift that to adult granddaughter. That gift is a tax-free receipt to the granddaughter. And now adult granddaughter can invest it however she chooses. But then going forward, it's taxable to that adult granddaughter, however she chooses to invest it going forward. But the actual withdrawal in this situation is taxable to the RIF owner, grandma in my situation.
Great. And I think we have time for one more. If I put my home in my name, my husband and son's name, would that decrease the inheritance tax? Is this unwise?
Okay, I want you to do, and again, this is general information, so I want whoever's in this situation to come back and follow up. So husband and wife, joint with, what we would do is it's joint with right of survivorship. So let's statistically, husband passes away, then wife becomes the sole owner. Now what happens is that, okay, let's just say in our scenario, aging mom puts adult son, joint with right of survivorship. So what mom is thinking is like, oh, I'll pass away and I'm going to pass directly to son. But son has his own home, his own principal residence. So what mom has done here then is that she has negated half of the principal residence exemption on that house because son is the co-owner. And so she's trying to simplify her estate. And I think that the taxes due to the taxable portion of the capital gain, because she doesn't have, son doesn't have the principal residence exemption for that, would negate any simplifications. So in most situations, I would tread very, very cautiously before doing that.
Perfect. Thanks, Michelle. And you know what? I think that brings us right to the hour. Michelle, thank you once again for your time, your expertise, and for partnering with us, and Fidelity as well, to continuing to help empower our members on their retirement journeys. Everyone who joined today, thank you for spending your lunch hour with us. We hope the session helped bring a little more clarity to your retirement planning. We covered a lot from government benefits, those real risks, ironically, such as living too long, navigating inflation, making smart withdrawal choices. If you'd like to speak with someone about your personal plan, our Tandia Wealth Advisors are always here to help, whether you're just getting started, maybe you want a second opinion, or maybe you want to build a full retirement strategy. That's what we're here for that. And with that, we'll see you at the next webinar. And take care and have a great rest of your day.